Good morning. Hello and welcome to the June edition of our Tax, Retirement, Investment, and Insurance Planning Strategies and Solutions webinar. My name is David Thomas, and I'm the Director of Tax and Estate Planning on the life insurance side of our business at Empire Life. In this presentation, I will be providing an overview of our new additional deposit option feature on our PAR life insurance products, plus looking at the additional deposit option, or ADO as it's often referred to, in action in one of our popular sales strategies. You will note that this presentation is titled Part 1. In Part 2, in a future TRIPS webinar, we will review additional sales strategies and how they compare using the ADO feature. And in closing today, we will be showing a video of how to use ADO in our illustration system and where to see the ADO output in the illustrations provided. Our disclaimer information, please read carefully. And one particular note, I will be using reference to products, so please take note of that. So before we start into the sales strategy, let's do a review of the additional deposit option, or ADO, features. ADO is an exciting new feature we have here at Empire Life that may help enhance the strategies we are going to discuss. The additional deposit option is a feature used to enhance the value and flexibility of a participating life insurance policy. Over and above the base premium, the clients can elect to make tax-exempt additional deposits to their policy that will be used to purchase paid-up additions. Paid-up additions purchased from additional deposits are added to the paid-up additions purchased from policy dividends and will almost immediately increase policy values. The additional deposit option is a feature that can be most appreciated by higher income, incorporated business owners or professionals, and baby boomers looking for optimal early cash values and flexibility within their life insurance. Business owners will like the idea of flexibility that is offered with additional deposits, whether it is to have the policy paid up earlier using the premium offset feature, which is greatly improved with additional deposits, or access to high early cash values for emergencies or other business needs. The additional deposit option will also accelerate the crossover period when using the enhanced dividend option. The crossover period is that time when the dividends no longer needed to support the enhanced coverage option added to the base coverage and can now be used to purchase paid-up additions. Self-employed professionals will also appreciate the additional deposit option. ADO, in this case, will also assist various concepts often used by business owners or self-employed professionals. The feature can be used to both accelerate the growth of the estate values, which is helpful for legacy building concepts, as well as increase the early cash values available, which benefits certain concepts such as insured retirement plans or immediate financing arrangements that use leverage based on the cash values in the policy. For baby boomers with significant non-registered or corporate assets, this feature can accelerate the growth of the values of their coverage, as well as provide significant access to significant cash values for emergencies or supplement their retirement. The ability to quick pay the policy with early premium offsets will also appeal to this target market. Now let's take a look at some of the features of the additional deposit option. To start, the additional deposit option feature is available on both Estate Max and Optimax Wealth plans. It is available with the 10-pay, 20-pay, and life pay payment duration options of the plan. In addition, we can add it after the guaranteed payment period ends, and that includes adding it to the 8-pay plan. For in-force plans, we can add the additional deposit option to policies with a start date of October the 1st, 2019 or later. Minimum deposits for juveniles age 0 to 17 are $25 per month or $300 annually. For adults, the minimum is $100 per month or $1,000 annually. And again, these additional deposit options can continue after the contractual payment has stopped. The additional deposit option or the additional deposits themselves can be added either monthly or annually. In most cases, no additional underwriting is required when adding this at the time of application. We can also provide additional deposit holidays for up to 36 months without requiring additional underwriting. For in-force plans, we can add the additional deposit option within 24 months of the policy date with an application for change, addition, or reinstatement of additional deposit options. We can add it to term conversions as well, although there are restrictions, and for more information, please contact your account executive. The maximum annual additional deposit amount is based on the tax-exempt room for the illustrated policy. We do also offer flexibility to illustrate a specific amount between the minimum and the maximum. And this last point is an important one. The maximum lifetime additional deposit amount is based on the illustrated deposit amount multiplied by the number of years the deposits are illustrated for. So keeping those features in mind, the strategy that I want to review with you is the Corporate Legacy Builder. For those of you who were on our call a couple of months ago, this was one of the strategies that we reviewed at that time. So today you will be able to see the results of this strategy when using the additional deposit option and see the benefits provided when using it. The examples will demonstrate the value this strategy may have as an asset class and how well it performs in a low interest rate environment. The Corporate Legacy Builder is a strategy that enables business owners to grow passive assets and/or surplus profits on a tax-deferred basis. This alternative to a company's taxable investments is designed to provide a business with higher tax-free value of the business for the estate or surviving shareholders. It permits a business to benefit from tax-deferred program with no increase in risk, while permitting access to cash for business needs. Holding companies and management companies often contain cash and investment assets that are not used in the active business. These assets locked away within the corporation can usually only be paid out to the individual shareholders as a taxable distribution, unless there's a capital dividend account balance available. Although conventional GICs offer security of a guaranteed rate of return and guaranteed principal, taxes must be paid on an annual basis. Real returns can be low or negative, and both the principal and interest may be subject to probate tax on the death of the investor, as the share price is included in their estate value. Investors can purchase a conservatively managed fund held within a participating whole life plan. The income tax allows these investments to grow on a tax-deferred basis for as long as they stay in the plan, ultimately being paid to the heirs tax and probate fee-free. As you will see, permanent participating life insurance performs well in a low interest rate environment and may be a valuable asset class for your client. Would your clients be interested in knowing about ways that these locked-in assets could somehow be transferred to the shareholders on a tax-free basis? Of course they would. And this is where you can help your client understand how this can be done and why life insurance is the key to the solution. As well, we should always keep in mind that bringing concepts like this to your client usually involves their accountants or lawyers, and establishing relationships with these professionals is important. We are generally all familiar with a number of the advantages of using corporate-owned life insurance. It provides immediate and higher estate values than other investments. It shelters the growth from taxation on the funds invested. It provides tax-free payouts on death to the corporate owner. And in fact, life insurance death benefits are always tax-free, but when we're talking about a corporate owner, we bring into the conversation the advantage of the capital dividend account for reduced taxation to the estate. So these are the advantages that we already know and love. But now it seems that we can add another advantage to that list. Cash value life insurance can help alleviate the increased active business taxation from the small business limit clawback resulting from our new passive investment tax rules. And all of these items will point to how corporate life insurance may be a valuable asset class to the business owner. So these are the essential components of the concept. The key advantage, again, is using tax shelter growth and tax-free benefit of a whole life contract. And what's the trick to the plan that makes life insurance so effective? The answer is the capital dividend account, or CDA. The CDA is generated on the payout of the insurance proceeds as a tax-free amount to the beneficiary. When that beneficiary is a corporation, it receives a capital dividend account credit, which is the insurance proceeds that are in excess of the adjusted cost basis of the policy. In our scenario, if the accumulated earnings that are transferred to the policy can then be paid out tax-free to the estate of the deceased shareholder using the capital dividend account, then we have achieved a corporate estate transfer. From a target market perspective, this strategy generally appeals to the more mature client, noted as age 50 and over in this slide, but it's generally the more mature client that has an idea of what they want to use for their own retirement purposes versus leaving for a legacy. Corporations with large retained earnings, holding companies, and occasionally we still see investment or management companies. Most often the management companies might be in the real estate industry. So your call to action would be take a look at your client base. Make a list of 10 clients that you have that own corporations. Note their ages and determine if you know if there are investable assets inside the company. And those would be the clients that you should be considering for this strategy. So here's a picture of the situation. Assume a holding company has $500,000 of retained earnings in the company. A transfer of those funds to the individual shareholder as a dividend will attract tax at an average rate of maybe 45%, depending on your province of residence, or $225,000. This is an average of the various provinces' non-eligible dividend tax rates at the highest tax brackets, generally taxable income over roughly $210,000. This occurs whether the dividend is paid to the shareholder during his lifetime or is paid through the estate. Clearly, you can see that the retained earnings accumulated would suffer an immediate reduction if paid out to the shareholder. So the case study I want to review is for Brad and Janet. Now, Brad and Janet are a couple, age 60, non-smokers. They have $500,000 in their holding company in a fixed income portfolio with a target rate of return of 3%. Their objectives are to achieve capital preservation for the next generation, and they have various retirement income sources such that they do not need the income from this portion of their asset base. Now, for those of you who remember Brad and Janet, and I mean from our case studies, not the movie, there are a couple of differences in their situation I want to point out today. The first is that our originally recommended solution for Brad and Janet has had a pricing change since we first looked at their case. So I want to demonstrate that our corporate legacy builder strategy is still an extremely effective and competitive strategy. And the second and main reason I wanted to revisit them today is to compare our original recommendation of an 8-pay estate max policy to our new additional deposit option that is available with our PAR plans, Estate Max and Optimax Wealth. Please note that this additional deposit option feature was introduced at the end of May. So what we're going to recommend for Brad and Janet is to set up a joint and last to die policy on the shareholders, on their lives. They're looking for approximately $1 million of additional face amount needed for estate liquidity, legacy, and optimizing tax sheltering. We are going to review two different deposit structures today. Actually, the deposits will be the same, but the way we structure the policy will be a little bit different. The first one, we're going to look at the guaranteed 8-pay. So we're going to take the $500,000 over 8 years at $62,500 and use the guaranteed version. On the second one we're going to do is going to use the base plan of a life pay and have premium offset achieved after 8 years by use of the additional deposit option feature. So the same $62,500 a year going into the policy for 8 years. It is worth noting that in the AdCalc software, the illustrations are driven from the insurance illustration's primary values, so the current dividend scale for the par products used. But if you use an option of current -1 and or current -2% in the illustration software, in the insurance illustration, these values will also be transferred to AdCalc to create a corporate legacy builder concept illustration at current -1% and or current -2%. This functionality helps assess how well permanent participating life insurance performs in a lower interest rate environment. So for this solution, we illustrated an estate max insurance policy using paid up addition dividend option. Estate max was used since it generally creates a larger estate values than Optimax Wealth, and paid up additions were used to create the highest long-term estate values. And of course, to facilitate the comparison that I want to show you in my next version of this case study, which uses the additional deposit option. Of course, in your cases, you will decide with your clients which options work best for them. So in this case, we have their $500,000 of available capital allocated as 8 payments of $62,500 per year, which is purchased just under $900,000 of initial coverage. Please note that the single equivalent age for this policy done on a joint and last to die basis is age 50. So this illustration is created in our Envision illustration system, passed over to AdCalc to create the corporate legacy builder illustration. When this illustration was passed to AdCalc, the additional assumptions used were the alternative investment that we're going to compare to is a 3% rate of return fixed income portfolio. The corporate tax rate was 50 2/3%, and their personal non-eligible dividend tax rate was 45%. Now, we all recognize that they may not be getting 3% on their fixed income portfolio today, but they're relatively young at age 60, and they anticipate getting 3% over their retirement years. The tax rates here are not specific to any particular province, but just a representative average of rates across the country. Now, this screenshot of the AdCalc executive summary shows the results of the corporate legacy builder strategy at 10-year intervals. There is also a detail page in behind this that has every year up to age 100. The key driver for this concept is the increase in the after-tax payout that can be achieved from the corporation to the estate. In this example, the results indicate that a dramatic improvement in estate values for the insurance solution over the alternative investment. In this case, with two 60-year-old clients, I have focused on the 30-year results, assuming that the second of Brad and Janet were to pass away at their age 90. At this point, there is over a $1.1 million increase in the after-tax benefit to the estate by using the corporate legacy builder strategy, or over a 230% increase. This concept illustration also provides a pre-tax equivalent rate of return calculation for each potential year of death, indicating the rate of return that would be needed to be earned inside the corporation to match the benefits of the corporate legacy builder solution. At the 30-year mark, this is almost 11%. Now, for those of you who remember when we looked at Brad and Janet and were using the enhanced dividend option rather than paid up additions, or even for those who don't, it may be worth mentioning the differences in the results here. The use of paid up additions provides lower earlier returns without the benefit of the enhancement, but by year 30, the results are slightly better with about an additional $20,000 or estate benefit, or an additional 4% improvement over the alternative investment. The quick pay approach that we see here has been a very popular approach to the legacy builders solution for the past few years, even back when we started with our quick pay universal life product. And it continues to be popular given how well it works with our guaranteed 8-pay Estate Max product, or even our Optimax Wealth product, which I have not shown here today. It should remain popular with those clients who have the funds available. And of course, the next thing I'm going to show you is how we can use those funds using the additional deposit option. So I started with the 8-pay example, since I expect a great many of you have seen that example before, simply to give you a perspective on how the new additional deposit option structure compares. One of the main reasons ADO was added was to create some flexibility with respect to premium payments. This screenshot is for the same case you just saw, using the same $500,000 over an 8-year period. Only here I've used a lifetime contractual payment period offset after 8 years with the maximum allowable additional deposit amount, also stopping after 8 years. It has the same tax rates, alternative rate of return, and also prepared using the paid up addition dividend option with Estate Max. This time, one of the first things you may note is it purchases almost $1 million of initial coverage instead of just under $900,000 with the 8-pay, guaranteed 8-pay Estate Max, an increase in the initial coverage of over $96,000. The advantage of the higher initial coverage with the additional deposit option is quickly compounded by year 10. The coverage amounts grow very quickly through the deposit period, in this case, 8 years. I don't expect you to remember the numbers from the guaranteed 8-pay summary, but by year 30, the contract with additional deposit options provides a marginally better after-tax payout than with the 8-pay version. This despite a slightly lower coverage amount, indicating the contract with additional deposit options has a lower adjusted cost basis at year 30, and therefore better capital dividend account credit. The slight advantage by using ADO and the corporate legacy builder at year 30 is eroded in later years, since the coverage amounts under this structure grow much more slowly than the guaranteed 8-pay version. But when we focus on the 30-year point in this illustration, there is almost a $1.2 million increase in the after-tax benefit to the estate, $59,500 more than with the guaranteed 8-pay by using the corporate legacy builder strategy, or an almost 250% increase over the alternative investment. And in this case, the equivalent pre-tax rate of return still worked out to over 11%, slightly higher than with the guaranteed 8-pay. So structuring a policy with additional deposit options for a corporate legacy builder will be a very competitive offering for those clients who are looking for a plan with some premium payment flexibility. And as I've noted earlier, it shows how well permanent participating life insurance performs in a comparatively low interest rate environment. In the context of the corporate legacy builder strategy, which is focused on older ages, I compared a number of situations for Brad and Janet, a couple, each of whom were age 60. Before I looked at older ages, however, I wanted to comment on the behavior of the different policy structures between both our guaranteed 8-pay and a life pay structure shortened to 8 payments with the ADO feature. The observations noted here are based on just this case. And while I used Estate Max for this case, I had also looked at Optimax Wealth, so these comments generally apply to both products except where noted. The biggest distinction, and likely the most obvious one, is that our guaranteed 8-pay contract is just that, guaranteed. However, it comes at a cost of no flexibility in those 8 premium payments. By contrast, the additional deposit option structure provides flexibility with respect to making the additional deposit portion of the premium payment. But this flexibility, of course, comes at the cost of the guarantee of the number and amount of payments required. The additional deposit option is only available with the paid up addition options when the early premium offset is used. So paid up additions were used in this case, and the behavior of the coverage amounts over time for the guaranteed 8-pay is a constantly growing coverage amount. Not so with the maximum additional deposit option scenarios. They start off with a slightly lower coverage, but grow very quickly through the deposit period, and then start to reduce until 20-some years out, and then start to grow again, but not as quickly as the coverage under the guaranteed 8-pay contracts, which eventually exceed the higher coverage in the middle years with the additional deposit option version. In later years, particularly really later, as in beyond life expectancy, the guaranteed 8-pay contracts provide higher coverage. Early cash values are the highest with Optimax Wealth and the additional deposit option. But beyond year 10, the guaranteed 8-pay version has higher cash in Optimax Wealth. So with Estate Max, the higher cash values are in the guaranteed 8-pay version all the way through. So keeping in mind all these differences, depending on the age of your clients and the benefits that they are focused on, you may have to look at more than one option to determine the best solution for your client. So with those comments in mind, this is a sampling of the numbers I had for some of the scenarios I ran for Brad and Janet. Only the 8-pay Estate Max did not provide the $1 million of coverage that was targeted for this case, well, at least by the end of year 1. As noted on the last slide, the coverage amounts ramp up very quickly with the additional deposit option structure. So choosing the right combination of payment period guarantees or additional deposits and initial face amounts, and even with Estate Max versus Optimax Wealth, will be a function of what is most important to the clients. In addition to the ones that you see here, I also looked at scenarios with higher initial face amounts and lower amounts of additional deposits. I could generalize by saying you can start with a higher face amount, but it ends up with lower face amounts since the growth is limited by the lower amounts of additional deposits. The other thing that I wanted to review with you is the results for clients at different ages. Here I have the results that we just reviewed for Brad and Janet, a couple each 60 years old with a single equivalent age of age 50. As noted when we went through their case, when we moved from using our guaranteed 8-pay version to a life pay version shortened down to 8 payments by using the maximum additional deposit, we got an improvement in all the key measures I've looked at on this slide. The initial face amount increased by about $96,000. The benefit in 30 years from using the corporate legacy builder strategy over the alternative increased by almost $60,000, and or an additional 12% improvement over the alternative investment. And the pre-tax equivalent rate of return increased, in this case by 26 basis points. All in all, a very good improvement in the results. Of course, you need to bear in mind the key distinction between the two approaches, aside from the results, is the guaranteed 8-pays guarantees, while the approach with additional deposit option is not guaranteed, but instead has flexibility with respect to premium payments. So that's the results for my 60-year-olds. I also reran as if Brad and Janet were now age 70. That's only one particular age, so I wanted to look at different ages. And this is the sample with two 70-year-olds, again on a joint and last to die basis, which worked out to a single equivalent age of 61. For comparison purposes, I've now looked at 20 years out. The results are consistent with the previous couple, age 60, in that results improve with the use of additional deposit option. However, some benefits have increased, while the first one, initial coverage, has not increased as much as for the two 60-year-olds. The initial face amount here has only increased by some $6,600. And the estate benefit, now looking 20 years out to something closer to life expectancy, has actually risen to over $120,000 more, or an additional 30% improvement over the alternative investment. And the pre-tax equivalent rate of return increased by 142 basis points. So some measures up significantly. Next, I moved on to a single life, 65-year-old male. As the age continues to increase, some of the trends in the results also continue, but others do not. The initial face amount advantage has now dropped to a disadvantage using additional deposit option. Here, with a 65-year-old, we have a lower initial coverage amount by over $33,000. The estate benefit, now again in 20 years, while still greater with the additional deposit option than the guaranteed 8-pay, has actually dropped to $21,000, the smallest advantage so far. So just a 5% improvement over the alternative investment strategy. And the pre-tax equivalent rate of return calculation has increased by 27 basis points, very similar to our two 60-year-olds. Those equivalent pre-tax rate of return figures demonstrate how well this participating life insurance performs comparatively in a low interest rate environment, or even when compared to some potentially higher performing investment alternatives without the associated investment risk. And the last age I wanted to look at was a single life female age 71. Here I've looked at year 16, which may be closer to life expectancy for a 71-year-old client. And while the initial amount of face amount of the policy with additional deposit options continues to shrink compared to the guaranteed 8-pay version, the estate benefits of using Corporate Legacy Builder have reversed and started to increase again. So here we have an initial coverage amount deficit with the additional deposit option compared to the guaranteed 8-pay of over $50,000. And while the absolute dollar advantage of the estate benefit using Corporate Legacy Builder continues to decrease, the margin and advantage of additional deposit option over the 8-pay, guaranteed 8-pay, has risen to close to $100,000, again, $97,669 actually. Giving an additional 20% advantage, 27% advantage, sorry, over the alternative investment by using the additional deposit option. And the pre-tax equivalent rate of return has increased by almost 2 full percentage points at 197 basis points. So it's important to note, while this analysis provides some insight into the results of using Empire Life's additional deposit option and certain sweet spots for ages where it might work better, we do not at this point have an analysis of our sweet spots using the various strategy compared to different issuers' products that also use the same funding option. We will continue to work here to provide you with some competitive analysis as well. Now, I know this slide looks just like the last one, but the variation that I wanted to talk a little bit about here is simply the results of this strategy using a current -1 dividend assumption. Now, fortunately, the pattern does appear to follow exactly what we saw at the current dividend rate, which is an initial coverage amount that starts off higher using ADO than with a guaranteed 8-pay. Then that advantage erodes at older ages until by age 65 and 71, it is turned into a reduced amount. The estate benefit amount is greater with additional deposit options in a single equivalent age 50, even more so at a single equivalent age of 61, but lower at the older ages of 65 and increasing again by age 71. And the pattern for the percentage of increase of the Corporate Legacy Builder strategy over the alternative investment, as well as the equivalent pre-tax rate of return, follows the same pattern we saw at the current dividend scale. Of course, as expected, all these differences between using guaranteed 8 pay or life pay with ADO come at a reduced dollar benefit amount with the reduced dividend scale. This does illustrate, though, how well this strategy still performs under alternative lower rates of return scenarios. But both approaches yield a very compelling case for the corporate legacy builder strategy. Even the least beneficial results we see at any age, dividend scale, or policy option provides significant benefits to your clients. It becomes a question of which benefits are most important to them, and we can help you structure the policy most appropriately. Please do not hesitate to get in touch with the insurance account executive in your region, and we can help you best meet your client's needs. So that concludes the portion that I am going to talk about. So thank you for listening. And next you will see the video on the illustration system and the results of using ADO in an illustration. Thanks, and we'll see you on the next webinar.